Francis Tan is a Chief Strategist Asia at Indosuez Wealth Management. He's joining us live from our SGX studio. Francis, good morning. Thank you so much for coming in. A good call on the yen because you're calling for overweight. You saw an intervention at around 162 level. We got that confirmation on the joint intervention. My question is, what next? When you see 142 for this cross, does it take another round of intervention, or was the message so strong that it will just naturally get it up there?
Very good morning, and first of all, thank you for having me over here today. Frankly, I really have to explain that the call for a 142 to the yen wasn't because I expected an intervention, or even more so a joint intervention by the BOJ and their US counterparts. However, we have been calling for a stronger yen basically a couple of months ago, mainly because fundamentally the yen is really too undervalued. We have been looking at some of the indicators or measures of fair value, and we certainly see that the yen is really on the underappreciated or undervalued stance. So basically, I believe the market is now waking up a little bit to the reality that there is a potential of the US coming in together with the BOJ to help at least provide some stability in the yen. It's not the one-side trade. Now, while Lisa just now was mentioning, of course, back in 1998 during Asian financial crisis and also 2011 during the Fukushima, both situations were disasters that happened, and those are exogenous shocks that happened, and that's why they needed to stabilize the yen. Now, right now, we aren't really seeing the world going through a potential big exogenous shock. But of course, you can mention that what's happening in the Middle East could be one, but then that has already been doing so for the past couple of months already. So I believe this goes to show, on a very surprising note as well, that both central banks of the global leading central banks are coming in to put a backstop to this, and I think it's going to be quite credible.
Yeah, and what kind of effect would it have for other Asian currencies like the Chinese yuan and the Korean won? Because you do see further appreciation for the yuan as well. Is this the moment that Asian currencies go back up and the dollar goes back to softening?
Okay, for one, there's quite a bit of a big difference between what's happening to the Japanese yen and also in Chinese yuan and even the Korean won. For one, the Japanese yen is one of the world reserve currency from a developed market. For the Chinese yuan, of course, it is a controlled currency and not really a reserve currency for now. But our expectations of a stronger yuan or renminbi is mainly because of the economic environment. Of course, as what Sri mentioned just now, last week we do see a contraction in the PMI that doesn't really do well for the whole Chinese economy. But I think while we're going to see the rating dots PMI, and that's private sector PMI, and like a trend of what we have seen in the past, I think the private sector is still going to do stronger than what we have from the SOE or the the public sector's PMI.
And, pivoting to China, Politburo meeting and some weekend rhetoric, do you think it was aggressive enough, not urgent enough? Because we actually heard, we just had Iswar Prasad from Cornell University basically saying that China needs a new growth model. This is not going to be just China's problem. So it needs to have a greater sense of urgency to addressing some of the macro problems. Do you think that it should... do you think Beijing understands that? Do you think the messaging from the July Politburo meeting was enough for you to feel okay with some of the assets that you like in China right now?
Yeah, regarding that, I think first of all, the global community of investors and analysts were a little bit underwhelmed. But I think that's unfair to think about that. And you mentioned just now, Chery, about China's new economic model, growth model. They are already implementing it. And just to give you a simple anecdote, back during 2020 or even before 2020, China was not really a strong car exporter in this world of big boys, right? Right after COVID, 21, 22, 23, China today is the world's largest exporter of cars. And that is only one small industry that we are talking about. We are not even talking about how China is trying to gain leadership in the world of quantum computing, cloud, and big data, and AI, and even semiconductor manufacturing. So China is already or has already been embarking on this new economic growth model, and that is to uplift the entire population or the entire society via moving into the new economy of technology. So I think it's really unfair for the world to say that China's economy is slowing down because of real estate. Real estate issue has always been there. It's not going to be a short-term issue. It will be quite long drawn, but at least the good news is that it's bottom, and the only thing we can see is just upside.
So do you see the trade of shorting Korea and go long on China right now? Is that something that you would agree with and already doing?
No, not really. First of all, it really depends on the client profile. For now, the sell-off in the Korean, I think, is bounced back up a little bit more. But at the end of the day, if you look at the forward earnings, the forward PE of Korean stocks in general, I think it's really on the attractive mode. Right now, is of course, is the sell-off that we saw for the past couple of weeks is really because of the exuberance and investors getting a little bit jittery. But if you look purely at the fundamentals and the valuation, I think there's still more upside, especially for those who have missed out on the earlier rise in the Korean stocks.
I know we have to wait until the yen finds its groove, right? But Japan is back, isn't it? It's got reflation that's taking root. Corporate governance is improving, and Prime Minister Takaichi seems to be quite committed to this grand economic plan. So why underweight Japanese equities, Francis?
Well, the key issue about our underweight in Japanese equities is really because we are doing it on the total portfolio management basis. We were overweight. We are still overweighting in the U.S. equities. We are moving. We're going to a little bit more optimistic in Europe. So we have to find a place where we have to underweight. But underweight doesn't mean no weight. It's just on the longer term strategy asset allocation. We are just making some tactical moves right now.
Onto the US, and we continue to see this secular 17-year bull market keep trucking. Are we seeing the first cracks?
Well, I don't really think that we are seeing the first cracks in the US. At the end of the day, if you look at the listed companies in the even S&P 500, they are really not just American champions, but they are global champions. So if you're an investor with $100 right now and you think to yourself, I have a 20-year or more investment horizon, cracks in between are cyclical shortfalls that I think are opportunities to buy on the dip. So I don't think we are seeing cracks.
There's life, though, beyond the entire AI data center chip story. And while we wait for all that volatility in the dust to settle, no doubt there's a strong long-term and the super cycle seems to be intact. But for right now, that repricing is going to continue. Aren't there better value opportunities outside the chip sector and the AI trade? And if so, where are they?
Certainly. So I believe one of the more unloved sector is the software sector. I think the world did a big rotation.
That's interesting because you can argue that Microsoft saved the market last week.
Yes, that's right. What a big jump in the Microsoft share price. So I think the world was perhaps too concentrated going upstream in the entire AI, going towards the chip makers, and some of the unloved software were unfairly sold off. I think there's value. Don't just look at them as software makers. Look at them as software makers with the distribution network, existing clientele, and their growth opportunity because they're implementing AI into it. So we talk a lot about Copilot, and I think this is certainly unfair to Microsoft over the past couple of weeks or even months, and those are really opportunities for us.
Ultimately, though, Francis, aren't we in a bear market for bonds, a bull market for energy, and doesn't that mean higher, longer-term borrowing costs, fiscal imprudence as well, whether it's in Japan or in the US with deficit spending? And isn't that the major story that these markets are neglecting to price?
You see, the world right now, government and corporates are having a ballooning debt issue. Now, the thing about balloons is that you never know when it will pop. but it is something that we are advising our clients to be really certainly keeping a lookout for. For now, we are not long duration. We are keeping our duration to the shorter to the medium term, mainly because of the interest rate sensitivity. And since the Middle East war started back in March onwards, the US has been seeing 10-year, 30-year Treasury yields have been moving on a higher and higher trend. That doesn't really seem to come down in a while. So I think that other than the long-term expenditure mode that the US has anyway, all this while pushing the total Treasury debt to be at all-time high, cyclically the world expects them to really bump up a little bit more because of military spending as well.
Bear steepening is telling us that. Bad news bears, Chery. Bad news bears.
Yes, exactly. And I just wonder if what we saw with the yen over the weekend and this morning with the joint announcement of the confirmed intervention, does this change your view on fixed income positioning going forward?
It doesn't really change our view, but like I mentioned, we are underweight on government bonds and we are keeping our duration shorter. So the operations by the BOJ effectively supporting the yen via the selling of the US Treasury will continue to move in line with our conviction. So it doesn't really change my view, at least over the next couple of months.
And I wonder what kind of asset class you're using as a diversifier then in your portfolios, because the fixed income didn't really function in that category. I know that you're still liking gold, but that call, I mean, how much of a conviction do you have that for a gold call right now?
Well, in fact, we have a pretty strong conviction on gold still right now. Our target for gold remains the same, 5,000. And although it has been coming down for quite a while over the past couple of months, we are thinking that it is sort of bottoming and there could be potential upside in gold. And gold, at the end of the day, we do not want to excessively trade it because gold is really indeed the insurance part of a portfolio. I've always gotten questions to Francis, where do you think gold price will go? I say that really depends on how much gold you have in a portfolio at the end of the day. Rule of thumb, 5 to 10% of gold, do you even have that? But of course, likewise, if you have too much gold, I think then you're overly concentrated in gold, particularly over the last 2 to 3 years where we saw everyone seemingly just buying gold and not anything else.
And we're seeing a lot of dispersion, right? Like it's really the story around having to get selective within the software space that you were talking about just now. And also you need to sort of get selective within Asia, within emerging market. And also when we're talking about volatility, sure, on the benchmark index level, things are calm, but it's really the single stock volatility that people are grappling with in certain sectors of AI trade that is working and not working anymore. So how do you build portfolios in times like this? And just to add to that, when we see these crazy moves, does that tell you about which point of the market cycle that we are in right now?
Certainly, Chery, and it's not just a single stock. Over the last couple of years, we have seen how concentrated even market benchmarks are or have gotten. I mean, a case in point, looking at even Singapore, looking at the KOSPI, looking at the Taiwan Exchange, even looking at the S&P 500, whereby the top 10 stocks is a big part of the entire market capitalization. So it's no longer as safe right now if you're going to put all your eggs into one market index basket, but it's really still more important for us to look into even cross asset classes. So the traditional 60-40, I don't think is dead. In fact, it's really a way to diversify and stabilize one's portfolio. The only thing is that we must cut it further, and it's not just a simple 60-40. Private markets are still an important part of the portfolio. Hedge funds are important as well. And at the end of the day, it's really a very fully diversified investment portfolio.
Francis, we got payrolls at the end of this week stateside. There was always volatility associated with this number. There's even more volatility now, arguably now that forward guidance has gone out of the window under Kevin Walsh. How big a market mover could this be?
The non-farm payrolls on a monthly basis has been usually a big market mover. But The key thinking right now is, like, as I mentioned just now, the S&P 500, suppose that's the market, is really a lot more concentrated on the AI play right now. The market seems not to be moving too much to the overall health of the US economy as a gauge of the S&P 500's movement for the next couple of weeks or even days ahead. So while non-farm payrolls is a very effective way for us to have a good barometer or a sense of the health of the US economy, that may not correlate well with the S&P 500 going forward.
Just very quickly, we've got $1.5 trillion of margin debt, highest in all time in US stocks. It makes the KOSPI and the leveraged ETFs look like a sideshow. Isn't that an accident waiting to happen?
No, at the end of the day, if you look at it, it's really a size, scale, it's economies of scale. And the US market is deep and liquid, built up over the years. And like GDP numbers, the economy grows bigger and bigger on a yearly basis. Naturally, we're going to see leverage on margins moving bigger. Nothing to be worried about. What's more important is the percentage of the leverage or the margins as a proportion of the entire market capitalization, whether that's gone up significantly or not. But that, I don't think so.
Francis, we'll leave it there. Thank you very much. Always great hearing your perspective and insights on the markets, the macro. Francis Tan there, Indosuez Wealth Management. We are back in 2 minutes.